What's up everybody, Adventures of Bitcoin here, and I'm going to do another video, a training type video. A lot of people have been asking me to do another one or to expand upon this video that I did here, which was kind of long. I actually shot it twice. It was really a lot longer. I cut it down to about 30 minutes, but then I realized that it might be easier to digest this material if I just do it little bits at a time. So I'm going to expand on this, and we're going to jump around a little bit. We're going to get into candlestick patterns, why we use candlesticks as opposed to some of the other charts when dealing with cryptocurrencies and stocks as well as futures or what have you. So let's get into it. So if we head over to TradingView, and I'm just going to use this blank space here as sort of a drawing pad. We're going to plot a graph. Alright, so back before we had candlesticks, they had a line chart. And a line chart looks like this, basically. It's a line chart. But what they had to work with back in the day, we're talking about your grandfather's day, they would plot a chart of a particular stock by its close. So let's say if we think in terms of days, a daily chart, the stock opens and then it closes at a particular price range, a particular price. So we'll mark that price here. And then the next day it opens and then it closes here. And then the next day it opens and it closes here. And then so on and so forth. And we just start plotting our graph. 1, 2, 3, 4, 5, 6, 7. Okay, here's 1 week. So now we start to connect the dots, and you can see this is how a line chart is formed, all the closes. Okay, so that's useful information. You can kind of see the direction of the trend and kind of where the stock's headed. But the problem is we don't know when it opened, we only know when it closed, and also we don't know what was the trading range. Were there more buyers and sellers? Were there more sellers and buyers? We couldn't see that with this simple line graph. So that gave birth to, let me erase some of this stuff here. So that gave birth to a bar chart, and which provided a little more useful information. They actually have a bar graph here. And if I come in zoom in a little bit more, you can see, now we're starting to see, we can see when it opens. Right, so let's pick this one here. We can see the open, and then we know that the stock went up. Well, we're dealing with cryptocurrencies, but we're talking about the past. It went up to at least here, and then it closed here. We have, 1, 2, 3, 4 data points in just one entry, which is pretty significant. And in the past, I don't even think they had colors. Like right now, we know by looking at this, because it's colored, it's got green and red, green meaning bullish and red meaning bearish. We know that it opened here and it closed higher than it opened. Also, we know it's because one's coming from the left and one's coming from the right. So in essence, you really don't need the colors. The colors help you to see easily, to recognize that the candle is bullish or bearish. But because of the way these bars are drawn, you know when it opened and when it closed, and the trading range. So bar charts were very useful for many years in trading, in the stock market, on Wall Street. And then at some point, somebody decided to switch to candlesticks. Some trader, and I don't know the exact history, but I didn't really catch on to the fact that they were using candlesticks in charts until around the 90s, around the dot-com bubble era. You remember those days? That's when I started seeing more and more candlestick charts. And candlesticks were invented by someone in Japan about 300 years ago for something other than stocks. But someone saw it, realized it had a great application in trading, and they started using it, and it's become the standard in stocks and cryptocurrency trading. So, and how they work is, and it's important to really understand what's going on with candlesticks, because there's a lot of information in just one data point. So if we pick one at random, so we'll pick this red one here. Let me get an arrow so you know where I'm at. So we'll pick this guy here. All right, so what this is telling us is, we know because it's red that this, let's call it a stock. Well, it's Bitcoin, so let's call it Bitcoin. We know that Bitcoin closed lower than when it opened. We know that because it's red. If it was green, it'd be the opposite. So we know when it opened. It opened right here at the top of the candlestick, or the candlestick body. And we know it closed below, so the bottom point is the close. It also has a wick at the bottom and a wick at the top. What that means is, some point during the day, Bitcoin's price went above the open and went below the close. So it traded within this range during the day, but it closed somewhere here in the middle. So if we move this over to a green candle, what is this green candle telling us? We know by looking at this that Bitcoin on this day, looks like maybe the 6th, the 5th, the 5th, it closed higher than it opened because it's green. So we know down here at the bottom is where it opened, and it closed right here at the top of the body. But at some point it went higher than it closed, but it was sustainable, so it pulled back a bit and it closed there, and it marked it as a close. What's also significant about these candles is not so much the candle itself, it's what's going on before it and what's going on after it. And you'll see why when we get into the different patterns to look for. So let's find another one. Okay, so here's a candlestick, an interesting looking one. Kind of looks like a marshmallow on a stick. What happened in this scenario? We know it opened, or it closed higher than it opened because it's green. We know it opened here at the bottom, closed here at the top of the body, but during the day it traveled all the way down to this, 33,604, and traveled all the way as high as 4,136, but it closed right here at the top, which is about $4,073. Okay, so that's how you read candlesticks. So now we're going to get into the various patterns to look for and what they mean. So what I suggest you do is Google and do a search for candlestick patterns, and pick one that I like to use a lot. Okay, so this is stockcharts.com. This has a pretty good comprehensive list of all the different patterns. I'm not going to go into every single one of these. I'm going to go over the ones that I use. I'm very much all about keeping it simple. I don't feel you need to know about every one of these patterns, what they're named and what they do. I'll just show you the ones that are common and that you'll see over and over again and what they mean. So the first one is a doji. Doji's formed when you can tell by what you can tell it's a doji because it looks like a plus sign or a cross. It's either going to look like a regular cross, an upside down cross, or it's going to look like a plus sign. Those are the three different dojis that you'll find. And what it means is it closed and opened at the same price, but during the day it had a very significant trading difference. So when it went down to a certain level and went up to a certain level, that's considered a doji. It has a long wick at the bottom, a long or short wick at the top, but the actual body is almost non-existent. What it's showing you is it's basically indecision between the bulls and the bears. They're having a tug of war contest, and nobody really won. Now, whether a doji is bullish or bearish really depends on what pattern it's coming out of. So if it's coming out of a a bullish pattern, it's an indicator that there may be a reversal coming, because you've had, let's say, 3 really big green candles, and now you see a doji. That means like all of a sudden now everyone was kind of in agreement that this thing was going higher, but now all of a sudden they can't agree. That usually means indecision, and it will probably go lower. Conversely, if it's coming out of a bearish trend, so if it's followed by, or I should say, if it's preceded by 3 big red candles, and then you have a doji, that means that the bearish trend now, so it's usually an indicator that it's going to reverse to the upside. Another form of doji is called the dragonfly doji. It's sometimes referred to as the umbrella doji because it kind of looks like an umbrella or a T. That's when the open and the close are at the top, but the bears pulled it down. So, but it closed right back where it started. So there was a lot of selling pressure. So again, it doesn't really matter the pattern. It matters more of where it is on the chart. So if it was preceded by, let's say, 3 green candles, then that would be considered a bearish dragonfly doji, because now it's probably looking to reverse that trend. And if it had 3 red candles before it, it's probably going to reverse to the upside. This is what's known as an engulfing pattern. That's when a candle overshadows the candle before it. So if the candle before it was, or if the candle is a bullish candle, so if it's green, and the candle before it was a bearish candle, so it was red, and it's engulfing that candle that was before it, that is very bullish. So that is a good indicator of a reversal coming. There are other patterns called the doji star and evening star that don't happen a lot. They're uncommon because there's a gap. That's how you know it's a star, because it's kind of like it's out there like a star in the sky. There's a gap in the price. Usually something happened to make the price shoot up from the previous close to the open. It changed so significantly, and usually it snaps back really fast. So that's what a evening doji star is. Evening star is the same thing, but it's not a doji, it's actually a candle. The opposite of the dragonfly doji is the gravestone doji. Again, if you understand what's going on with the candlesticks, it really shouldn't matter what the patterns mean, as long as you understand what's happening. You can pretty much figure out what's going on, because it's not so much the pattern, it's what's happening before it, what's happening after it, where it is in the chart. That's what really matters here. And if you understand what you're looking at when you're looking at candlesticks, you can pretty much figure out what's happening. So the gravestone doji, it opens at the bottom. The bulls pulled the price upwards, but the bears managed to pull it back down to the opening price, and it closed at the opening price. Another common pattern you're going to see is a hammer. There's bullish hammers and bearish hammers. They're usually an indicator of a reversal. This particular hammer is a bullish hammer because it is coming out of a downtrend. So let's say it had 3 red candles and then followed by a bullish hammer, means that it's going to reverse and typically go higher. A hanging man is the opposite of a hammer. It's typically very bearish. It's usually preceded by an advance, and it's called a hanging man because, you know, it looks like a hanging man. Or you could call it a square lollipop with a long stick. Here's an inverted hammer. It looks like a hammer but upside down, and it depends where it's located, but if it's here at the bottom of a downtrend, it's typically a reversal. So that's pretty much it that I wanted to cover for candlestick patterns. Again, you can come here to stock charts and look them up to get more in-depth information on them. But we have enough to kind of give us a good idea of what's happening with a particular chart. Another thing I want to briefly cover in TradingView is the days range indicator here over to the right. You can hide this pane if you want to by clicking that right there. A lot of people do that because they like the real estate. They want to be able to see a nice, they want the chart to fill up their screen. So the days range, you got to think of it kind of like a candlestick that's on its side, but it's just a little bit different. What this is telling me here is this is the days range. So going from the left to the right, with the left being the lowest price that Bitcoin has ever been for the day, and the right being the highest price that it's ever been for that day. So you can see at the left it's 11,425. We know it's gone that low, and the price has gone all the way up to 11,632 for the day. And right here you can see a little green line. That's the open and the close. So if we go back to the day, go back to the daily chart, we can see what appears to be a doji. Well, now it's starting to change because we can see this candlestick here is coinciding with this candlestick here. As this grows, this will grow. And what these little pegs are here, these are the bid and the ask. And you can see them here, the actual numbers here. And you'll see them fluctuate throughout the day. They're going to go to the right, to the left, giving you a clear view of what's happening right at this minute. And you know, the green is obviously the last price. You know, when you're looking at the order book, there's going to be bid, there's going to be ask, and there's going to be last. So the green candle, and if it was red, that means it's slower. It's lower than the open, just like a regular candlestick. But we know that this is indicating the last price, and these pegs are indicating the bid and the ask. So you can see these fighting all day long on which direction this is going to go. Now when I come here and I look at Bitcoin or whatever, and I see that this is a full green bar, both the red peg and the green peg or the blue peg are all the way to the right, that usually means it's full throttle, full speed ahead, and you've got a parabolic movement and a green candle in Bitcoin. Conversely, if the opposite is true and it's completely red, and both of these indicators, the bid and the ask, are all the way to the far left, then you're looking at a crash to the downside in almost every case. Okay, so now we're going to get into chart patterns. We're just going to do a couple. We're going to talk about, we're going to look for double tops, double bottoms, and then we'll show a cup and handle formation and show you what that looks like. And then we'll just kind of like draw some trend lines and try to make some forecasts based on what we see. So first, double tops. So right here in Bitcoin, this right here can be considered a double top, and the specifications of a double top is it has to be a new price. So let's assume that from here on, we don't know what's going to happen. Like right here, we don't know what's going to happen. All we see is this. So what we see is, zooming in, we see the price inching up. It hits an all-time high, and it pulls off that high, and then it touches it again. It actually went through it, but it closed below it. But it didn't actually go through, and that was confirmed by the next candle, which was bearish, saying it's going to continue going lower. So it's safe to say with a double top, that usually means it's an indicator of a reversal. So that usually means more to the downside, which is what happened. Conversely, a double bottom has the opposite effect. So coming out of a bear market, it'll hit an all-time low, or a low that it hasn't seen in a very long time. It'll bounce off of it, and then it'll hit it again, testing that floor, so to speak. What'll typically happen with a double bottom or even a triple bottom is that it'll bounce off and reverse the direction, so then it would turn bullish in that case. Okay, so here's an example of a double bottom here from stockcharts.com. You can see the price touched here, started to rally and tested it again, and then broke out. Conversely, at the bottom here, we can see double, triple top, basically testing that resistance line, bouncing off it, and heading into a bear trend. Alright, so that leads me to the cup and handle pattern, which is very, very common. You see it a lot. It's actually right here in the same chart. You can see it form right here. When you see this, it's typically bullish, which is what it did. It went higher. You see like a little bowl shape, a little rounded bottom, followed by a handle. The handle sometimes can look like this, or like this, or like this. It doesn't matter. It's really up to you to see it. You have to have the chart vision to spot it. So let's look for another one. I see one right here. See that? And look at where it went. Here's another one, kind of funky looking, but it's there. You'll start to see these all over. So now let's draw some triangles and try to figure out where we think Bitcoin is headed. Alright, the first thing, if we're looking at a daily chart, we're getting a really big picture. So we're thinking like far out time frame when we're looking at the day chart. So for that, I usually use two tools. I use Elliott Wave, as we talked about in the other video. So let's say starting from down here, we've got 1, 2, 3, 4, 5, and then followed by a correction wave of 1, 2, and 3. So judging by that, if we think that this pattern will continue, then we start over. Yeah, something like that. How high it's going to go is just going to depend. But you get the idea. So about $50,000 level. So, okay. Now we think this year the market's going up. We need to time our trades, our entry a little. We need to time our entry a little with a little bit of a smaller time frame. So I like to look at 30-minute chart, so we can really see what's going on, see if you can see the momentum. So what I like to do is I like to draw triangles, and I keep toggling back and forth between auto scale because I want to get this scale just right. Alright, so let's get a line and let's start connecting the tops. So right here we touching 3, so we got 1 top, 2 top, 3 top. You can also, depending on how optimistic you are, we can do this as well. We can pick this top. That changes the trajectory of the triangle a little bit, but that's fine. Now we're going to draw the bottom. And this gives us an idea of what might happen. And look what did happen. So we draw this triangle, drawing our trend lines, forms a triangle. It's trading within this triangle, respecting the lines, until one day it doesn't. And you can see here it broke out. It broke out here on big volume, big buying volume. But there's a lot of sell pressure, so there's resistance here at this line. So this triangle is our best bet. So somebody can look at this and go, okay, it broke the triangle, it's going to break out more. Okay, but if you also look, there's resistance here as well. Look at all these points here. 1, 2, going into all the way this far, all the way back here. So you've got resistance here. I'll have to draw this out so you can, I just want you to see what I'm seeing. Resistance there, all in here, arguably here, almost here. We've got this and this and this. So if we carry this on, we carry this line on. Let's change the color of this line, make it blue. We can see this is the reason for the resistance, because we are not the only ones looking at these charts and drawing these lines. Other people are seeing them too, and they're like, oh, there's resistance here, let's wait and see. So one person could see a breakout here and be very bullish on it. Another person may say, not so fast, let's wait and see what happens. But come on, we know Bitcoin can only go up, so it's just a matter of when. So just based on gut, I think somewhere in here it's going to break out more north and maybe test this resistance here. Well, first it's going to test this one, then it has to test this one, and another way to kind of, you can use Fibonacci to determine where it might be headed next. So, and it's not that hard, and again, it's subjective, so two people may draw it differently. So what we'll do is we'll grab the Fibonacci tool, the fib retracement, and then we'll pick our point. Where are we right now? We're right here. We'll zoom out a bit, and then we'll just find significant points. Like here's a significant top here. We could even go higher if we wanted to, but I can't get the graph, I can't get the scale to go bigger while holding this tool. So let's drop it there and extend it out. So you can see with the fibs, there's your resistance point there. There's another resistance point. Here's a major resistance point here. Another one here. And so on and so forth. So it's basically saying with these numbers, this is all buying area here, well into the green. And then when you start getting up into the reddish areas, you might be looking to sell for, if you're short term, yeah. So now all these tools and methods, they apply to any cryptocurrency, they apply to any stock, it doesn't matter, all the rules still apply. So that is it for today. Have fun, play around with some of the tools if you don't mind. Give it a like, a thumbs up, so it gets spread out amongst the masses so that other people can benefit from the content. If you'd like to add anything, because I know a lot of you are, more into the trading than I am and are probably more experienced. So if you have any comments or critiques, feel free to leave it below. If there's anything you want to see in particular, leave that, and I'll be sure to try and get to it. So that's it. Enjoy. Take a look at the charts. Let me know what you think. And stay profitable, my friends. We'll see you on the next video. Peace.